A SEP IRA versus a solo 401k. Let's compare the differences. So what if I told you there's two types of retirement plans that let self-employed business owners put away over $60,000 a year in a tax-advantaged vehicle, but most people choose the wrong one? And no, I'm not talking about the basic IRA that your accountant recommends. I'm talking about the SEP IRA and the solo 401k plan. We're going to talk about the key differences between them, and the differences are bigger than most entrepreneurs know. By the end of this video, you're going to know exactly how each of these plans work, which one lets you contribute more at lower income levels, which one stays simpler at tax time, and which one gives you more Roth flexibility. You'll walk away knowing which plan actually fits your business, not someone else's business, and it's the right fit for you. Most business owners don't realize they have so many retirement options. Employees get a retirement plan handed to them. Entrepreneurs have to build it themselves. Most self-employed people don't know the difference between a SEP and a solo 401k. And because of that, they leave tax benefits on the table every single year. So if you earn 1099 income, or you run an LLC, or you own a small business with no full-time employees, these are the two plans designed for you. So both have high contribution limits, but how you get there is very different. So as of the current IRS guidelines, both plans allow contributions up to the annual limit, but your income determines how much you can actually put in the plan. Here's the key difference. A SEP IRA only allows employer contributions. This means you can contribute up to 25% of your total compensation. So to hit the maximum contribution, you need very high income. Now, a solo 401k lets you contribute as the employee and the employer. That combination allows you to reach the higher contributions at much lower income levels. This is why entrepreneurs can put away far more in a solo 401k than they can in a SEP, even if their business isn't earning massive income numbers yet. So a solo 401k lets you contribute more at lower income levels. This is where the plan really separates itself from a SEP IRA, because the SEP requires high income to max out. You may need well over $200,000 in earnings to get close to the income limit through the employer contribution alone. A solo 401k lets you contribute the employee deferral first up to the allowed limit, even if your income is low. And then you can add the employer contribution on top. This is why the solo 401k is the go-to plan for consultants, single practitioner attorneys or doctors, real estate agents, contractors, online business owners, anyone with viable income where you don't have a lot of employees or any employees. Now, the SEP is simpler for the filing rules than a solo 401k plan. Here's where the SEP IRA shines. Very simple, no annual filing requirements from the owners. It's easy setup, easy maintenance. So in comparison, a solo 401k is more powerful, but it's also more work. So once your plan hits a certain asset level, you have to file an additional IRS form, which you'll have your CPA do, and you'll have to keep clean records around the contributions and plan administration. It's not that complicated, but it requires attention. If you want something simple, then a SEP IRA is definitely the choice, but if you want maximum control, the solo 401k wins every time. I would recommend hiring a competent CPA that understands the nuances of both of these plans, and with that competent CPA, that CPA is going to help you with compliance. So even choosing a solo 401k with the right CPA is going to be relatively simple because they're going to handle the details. I'm happy to share my CPA with you, who works with a lot of my clients. It's in the description below. Their name is Ellsworth and Stout. They're based in Las Vegas, Nevada, and they're quite familiar with the SEP and the solo 401k, and they can help independent business owners structure their retirement plans and maintain them for them at a very fair cost. Funding deadlines are critical here. The solo 401k employee portion must be in by December 31st. This is a big difference most people miss. Both plans allow employer contributions to be made up until the tax filing deadline after the new year, but with a solo 401k, the employee contribution, it must be made by December 31st. So if you miss that deadline, your solo 401k contribution is limited to only the employer portion. I think it's roughly $23,000 a year rather than up to the $69,000 total contribution. So if you miss that deadline, the solo 401k contribution is limited to the employer portion only. I think it's $23,000 a year, which suddenly makes it look a lot like a SEP. So plan ahead. December 31st matters, and make sure you talk to your CPA to abide by the guidelines. Another key point is Roth flexibility. The solo 401k is the clear winner. So if you choose a SEP, remember there's no Roth option. And what is a Roth IRA? Well, the Roth allows you to contribute post-tax. You pay the tax, put it in the Roth vehicle, but after that point, it's tax-free for the rest of the life of the investments in that fund. So if you take distributions, you get dividends, you get interest payments, or you sell assets, it's a tax-free vehicle, and why I love the Roth plan so much. What's nice is a solo 401k allows for the Roth option inside the plan. This is huge for entrepreneurs who want tax-free growth, especially long-term investors focused on real estate or private equity. Why it's helpful for real estate or private equity investments, but even stocks as well, is the distributions and the dividends, they're not taxed in the future. So you can live off of your retirement plan tax-free as it pays you out cash flow. So if Roth is part of your strategy, the SEP cannot compete. Remember, I'm not a financial advisor or a CPA. I am just sharing some of my insights about tax advantage vehicles that entrepreneurs can participate in. But if you want to learn more about setting up a solo 401k, a Roth IRA, a SEP IRA, then talk to a qualified accounting firm that understands these. I recommend my accounting firm because they understand the nuances of these different types of plans, and they practice biannual tax planning, so you can work with an educated advisor that understands how to meet your goals as a business owner. I'll leave their contact info in the description below. And ultimately, as a business owner, the worst thing you can do is not plan. So having some type of retirement plan for the future is critical. So start today.